Last week, we reviewed some common investing mistakes among professionals. We'll keep listening as we discuss even more and provide a general framework you can use to help yourself going forward. Hello, and welcome to the Wealth Minded MD podcast with your money best friends. I'm Dr. Alicia Taylor.
And I'm Dr. Brittany Halford.
And of course, we're here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time.
Alicia, can we talk about life insurance for a second? Because I feel like this is one of those things that people either avoid or overcomplicate.
Exactly. And honestly, a lot of us think we need these big, complicated, expensive policies when in reality, most people just need a solid term life insurance policy that actually protects their family.
And that's why we love working with PKA Insurance Group. They're independent brokers, which means that they're not tied to one company. They shop across all major carriers to find you the best option.
And what I really appreciate is that they're not trying to upsell you. They'll actually tell you what you do need, what you don't need, which is rare in the insurance world.
Exactly. Whether you're getting coverage for the first time or you already have a policy, they'll review what you have and let you know if it's solid or if there's something better or more affordable out there.
So if you've been putting off life insurance or wondering if you actually have the right policy or if your current policy is a good fit for you, this is your sign.
Reach out to PKA Insurance Group at pkainsurance.com or call 1-800-258-1018 to get started. And don't forget to tell him that we sent you. Also, the link is right in the show notes for your convenience. So click the link and get started today.
All right, Brittany, what's going on over there with you and your family and Boston?
Oh my goodness, Leisha, KJ is turning 5 this year.
Ooh,
Yeah,
the big 5.
I know. And when your child turns 5, what happens is they start kindergarten. It is quite crazy. I don't know. They say that the days are long, but the years are short. And that definitely resonates with me when I think about my children and how fast that they are growing. And so I am preparing him for kindergarten. I just registered him. I'm like, dang, do you all really need to know all this stuff? Like his sister is already there. You already have our address verified and all of the things. So I wish they would have made it a little bit easier for me, honestly. But with that, it's also a preparation of how do we get him to where he can be really confident? And it's difficult for me. So any listeners who have 2 kids, this might resonate with you. For me to gauge them and evaluate their progress differently, because when Brooke started kindergarten, she was almost 6 because she has a birthday after September 1st. So that's the cutoff. So whether you start or not. So she was almost 6. So when she started kindergarten, she was reading, she was doing more complex math problems, but KJ turns 5 in May. And so I'm trying to get him up to speed, but it's like, what is my metric here? Because his sister has so much more time. And so I just kept progressing her forward where I don't want to be so aggressive and progressing him when he's not yet there and comparing him to his sister all the time. So just a lot of mom stuff going on. We're working on getting him to read. I do want him to at least read 2 and 3 letter words and have his sight words mostly down before kindergarten. So that's what's going on in my world.
Well, I wish you much success in all of that and all of your, I'm trying to teach one to read. I'm trying to enroll them in 50 different extracurriculars. I want to vet their teachers 5 times. I'm just kidding. But it does make me think like, wow, there's a lot of work involved. It's not like you just have them and beat them. You got to educate them too. And I guess that's important and takes a lot of effort and entertain them. You know, you were talking about how you're doing all these activities. It's so funny. One of my friends, she was like, Alicia, I really want to be a good mom, but it requires a lot of my time.
Mm-hmm.
She's like, I don't want to just have them watch TV, but it is so much easier having them just watch TV. If I want them to not watch TV, it requires like my time. Like I have to be present and dictate the activity and do all of these things, and how it is much more exhausting than she anticipated. She talks about how it's so worth it. And I'm sure you feel the same.
Yeah, it definitely is worth it. But you're right. It takes a lot of time. And Brooke will ask me, she's so curious, like, Mommy, do you wish that you had another child? Do you enjoy being a mommy? Is it hard being a mommy? And I'm like, yes, I enjoy it, but sometimes it is very hard. And I think having those candid conversations, even though she's my child and she understands that I'm talking about raising her and spending time with her can be difficult, but it also shows her that you can have things in life that can be both rewarding and challenging simultaneously, and they're worth doing. So I try to be very thoughtful in my responses to my kids. But yeah, it's a lot of work. It is a lot of work, but it is very rewarding.
I'm happy for you. And I like the way you put it, that some things can be rewarding, even though they are challenging. I think that's a good life nugget for us to keep in mind. All right, so today we are delving into part 2 of common investing mistakes. We want you to win in life, win in investing, increase your net worth, become millionaires and multimillionaires. And part of that is avoiding some of these common investing mistakes. And so we'll just dive right into part 2. And I think another common investing mistake that I see is people who do not have a clear asset allocation. What do I mean by that? They don't really know what percentage of their money is in stocks versus bonds. They haven't really thought that much about their risk tolerance, or more importantly, they haven't thought much about their time horizon or how long they plan to be investing and when that stopping point might be. And so I think whenever you don't have a clear asset allocation and whenever you don't know some of these big picture things, it could lead to mistakes. It could lead to panic selling. It could lead to maybe you losing more money than you should have, or your portfolio not increasing at the rate in which you might have anticipated. And so one of the ways to avoid this is to really maybe sit down with your financial advisor if you have one, or if you do not, taking a look at the way that you're investing and saying, what is my asset allocation? What is the percentage that I have in stocks versus bonds? What is my risk tolerance? When am I trying to retire or be able to become financially independent and maybe cut down to part-time? And so understanding some of these big picture things, including your asset allocation, is really important. And when you don't do that, I think that's one of a very common investing mistake, shall I say.
I agree. And oftentimes I don't think people think about this. Like they're not being as strategic. They might just choose, especially if they're only investing with their employer, a target date retirement fund, which is an okay option. Like, don't get me wrong. I'm investing in target date retirement funds too. But once you start to add on additional layers with that taxable brokerage account, I think it is really important that you think through how you want to allocate your funds within that account. And then how does it blend with your target date retirement fund? So that's one of the things that I learned is like, oh, okay, let me not just see each account like, oh, this is my 401k and this is how this is invested. And this is my taxable brokerage account and this is how this is invested. But what is the total composition and asset allocation of all of the assets that I have invested in the market? And do I want to change it? And how do I want to change it? And what is going to be the trigger for me changing it? So we're approaching, well, Kevin's 40. I'm approaching 40. I'm basically 40 because in the next month I'll be 40.
Happy early birthday.
Thank you. And so now is the time for us to reappraise. Okay, do we want to make any changes now that we're getting older? And what is our time horizon? Because I'm not working until I'm 65. My plan is to retire at 51. And so how does that make me feel? What do I need to do with my asset allocation in order to accomplish that goal? Do I need to be more aggressive now and say, okay, if I'm more aggressive now and there is a downturn, then the worst case scenario is that I keep working. The best case scenario is that I can retire, right? And so either or. So what we're saying is just to sit down with yourself, take note of it, and then try to figure out not only what are your goals for today, but what are your goals for your lifespan, and see how your asset allocation helps you to achieve those goals.
Yeah, I love that. And I think if you are listening to this and you're like, I don't know my asset allocation, I don't know, maybe that's a mistake for me. If you're in that camp, I think there are some general rules of thumb that you can follow. One of those that I hear a lot is 120 minus your age is the percentage that you should have in stocks. And so if you're age 40, 120 minus 40 is 80. And so some folks might say maybe 80% in stock and the remaining 20% in bonds, right? If you were 30, 120 minus 30 is 90. And so maybe 90% in stocks and 10% in bonds. Other people use a more conservative formula. Maybe they use 110 minus their age or 100 minus their age. I think the formula that you choose to use probably depends on your risk tolerance. But I think having some sort of systematic approach that will help you figure out what your asset allocation should be and how it might change as you age is really important. And again, you don't have to change it each year. A lot of people kind of change it every 5 years or so. So, maybe if you are 40 or nearing 40, like Brittany is, maybe you have one asset allocation, and as you near 45, you might consider changing it. And as you near 50, you might consider changing it. And so rest assured, you don't have to change it each year, but I do think having a systematic approach to what your asset allocation is very helpful. And even if you have a financial advisor, having a meeting with him or her and saying, what is my asset allocation? Is there a reason you chose this for me? How might this change over time? I think those are some really important questions to clarify as you continue throughout your investing journey.
All right. So when I think about this, the asset allocation is a piece, but I've already kind of hinted to this in the investing mistakes. Part one is about taxes. And so, yes, there are tax implications on the type of investments that you're choosing, but it also really matters for the type of accounts that you're choosing. This is where your employer sponsored accounts like your 401k, your 403b, your 457b could be very beneficial because in those accounts, you don't get taxed anytime you trade, anytime you make a sell or you buy something. That transaction is not taxed. So you have tax-free exchanges and growth in the account until you pull it out, depending on what type of an account it is. If it's a traditional, then when you pull it out in retirement, make that withdrawal, you'll pay ordinary income tax. But if it's a Roth 401k or a Roth 403b or Roth IRA, then that's going to be tax-free growth because you're funding the account with post-tax dollars. But thinking about these tax advantages are really, really critical when you are considering how you're going to invest. Recently, I was chatting with my dad about his IRA. He has some money in a traditional IRA. And I was like, oh, no, he doesn't have to pay capital gains because it's in an individual retirement account. So he does not have to pay any capital gains tax on any growth if he were to sell or do certain things with the money that's there. So this is really important for us to consider.
Yeah, I think just like you have a bank account for your cash, you have an investment account for your investments. And the question then becomes, which account do I use and prioritize? I think earlier on in your career, you may have more accounts available than you have money to invest. It's like, okay, I got a lot of things on my plate. I don't know if I could max out my work retirement account and do my backdoor Roth and max out my 403b and max out my HSA and open a solo 401k. I don't know if I could do all of those things when I'm starting out. But as you continue to progress in your career and you make more money over time and you get those bonuses or your salary increases, I think you really got to start thinking about, are there ways that I can use more of these tax advantaged accounts? I do think there's something to be said about the flexibility of a regular brokerage account and being able to take the money out of the account at any time. So I do think it has its use, but I also think that if one of your goals is to build wealth over time, if one of your goals is to be able to retire sooner, then one of the things you want to make sure is that you are minimizing some of the taxes that you might have to pay on the money that you make as you are investing. And one of the best ways to minimize some of the taxes that you will pay is by using tax advantaged accounts. In other words, by utilizing accounts that allow you to save money in taxes some way, whether it's a pre-tax account that allows you to save money on the front end or a post-tax account that allows you to save money on the back end. And so if you are somebody listening to this and you are not already maximizing your work retirement accounts, meaning you are not already contributing the maximum that you can, which for 2026 is $24,500 as an employee, for those who are under the age of 50, then maybe that's something you consider. If you're not already doing your Roth IRA or backdoor Roth, that's something you consider. If you have access to a 457B and your employer is stable, especially if it's a governmental one, that's something you want to consider. If you make 1099 income because you give grand rounds talks and you get paid for that, you sell stuff on Facebook or eBay, you do some consulting on the side, you work at urgent care on the side or whatever it is, if you've got some 1099 income, then maybe you open a solo 401k and put some more money in there. As you start thinking about, okay, I want to invest and build wealth, you got to say, how can I save money on taxes? And maybe that means utilizing these tax advantaged accounts.
All right. So, Alicia, I have a question. You mentioned taxable brokerage accounts as far as flexibility. So, when you're talking to people, do you recommend that they max out one of the tax advantage accounts before they move into a taxable brokerage account? What is your strategy? What is your general recommendation?
Great question. I think it depends on what they're investing for. If they tell me they're investing to be able to retire early, to build wealth over time, then I'm going to tell them, for the most part, to probably maximize their work retirement accounts first. Most people get a match at their jobs. They get free money there. I think being able to save money in taxes during that tax year is very valuable for those in their peak earnings years. For most people, if that is their goal, right? I want to build wealth over time. I want to be able to retire early. Then maximizing at least their work retirement account first is the way to go for most people. Now, if they tell me, hey, my goal is to eventually be able to purchase a house in 5 or 10 years, or my goal is to eventually be able to pay for my kids' college and I want some flexibility flexibility there. Or, Alicia, I want to build wealth over time, but I also want money to be available to me if I see a great investing opportunity. Maybe I might want to get into real estate if a good opportunity arises. In that case, I do think it's good to have some money in a regular taxable brokerage account, right? It provides you that flexibility so that if you encounter a great investment deal or whatever, you can maybe sell your investments in the taxable brokerage account and then use that money and deploy that money elsewhere. And so I really think it depends on where somebody is in their investing career and what other taxable accounts they have available to them. And then lastly, like what their overall goal is.
Yeah, I appreciate that response because the flexibility does matter. We've used our taxable brokerage account to purchase a new car, and we've used it for some of the other investments that we wanted to pursue. And so the purchase of a car was not something that we had really planned for per se. We got in a car accident and we're like, okay, well, this car's too old to fix.
Sorry.
So instead of putting all this money in this old car, let's just buy a new car. And what assets do we have available to us that we can exchange for another car that we need, And so it wasn't that we were being impulsive. It's like at this point, we actually need a new car. So I appreciate that. I also appreciate that the growth is not taxed at ordinary federal income rates. So 20% of capital gains tax for us was the max. So anywho, we were taxed less than our federal income tax. So that is what I appreciate as well, that we had all this growth, but it was still not taxed as much as if we were going and exchanging our time and energy to earn the money to pay it that way.
Yeah, I think the money that you make on investing is taxed at a different rate than the money that you make actively from your job. And so keeping that in mind. And I think that segues nicely into another common investing mistake that I see, and that is people investing without a tax strategy or without regards to fees. One of the things that you got to do is say, okay, what is my asset allocation? Okay, if it's 90% stock and 10% bonds or 80% stock and 20% bonds, what stock-based index mutual funds am I going to buy? What bond-based index mutual funds am I going to buy? And when you are thinking about what stocks you want to buy or what mutual funds you want to buy, one of the things you need to pay attention to is the expense ratio, right? How much does it cost for me to purchase this thing? Because you not only pay like the cost of the thing, but there's usually a fee associated with it. And so you want to keep your expense ratios low, the fees with those mutual funds low. And oftentimes, if you were purchasing an index mutual fund, those expense ratios are already going to be low. And so I tell people to probably keep it under like 0.3 basis points. I think that even is high. A lot of your index-based mutual funds, you can get them as low as 0.05 basis points. And the basis points terminology is just simply what they use to classify like how much something costs. So the lower the basis points or the lower the fraction, if you will, the cheaper it is. And so making sure that you are looking at the fees associated with it and that you also have a tax strategy, as you mentioned, as if you're a high income earner, you're going to be paying a good amount in taxes. And so it's not only about how much money can I make in a certain investment, but it's about how much money can I keep after paying taxes in certain investments. And I know, Brittany, you and I have talked at length about your decision, you and your husband's decision to purchase businesses and do rental properties and do oil and gas investments and things of that nature because of their tax efficiency or because of the money that you could save on taxes. Especially as you have a higher net worth, as your wealth builds, you need to start thinking about what is my tax strategy? Trying to say, how can I minimize fees or make sure I'm not paying too much in fees for these investments?
I'm all about tax strategy, and you're right. It requires some planning when we're considering what we should invest in and how that investment is going to be taxed and how does that serve us and what other alternatives are available. So I appreciate that we're not just thinking about the account that we're putting it in, but also the type of investments and what are some of the incentives. Now, with doing this, you also want to consider, should I just pay the taxes so that I could achieve this other goal? So, Alicia, I really appreciate that when you talked about the type of accounts, you had it focused on your goals. And really, all of your financial decisions should be focused on your goals, not only the goal for today, but also the goal in the future. And thinking very long term when you're creating these strategies. But you're right. We've invested in many different things for tax purposes that align with our goals. And we also give ourselves permission to change direction. So being transparent, because that's what we do on this podcast, we didn't invest in oil and gas in 2025 because we had other things that could help us with our taxes. So you just want to make a strategy and plan it out and really think about what are the implications, what are the potential risks of that investment as well.
Yeah. Another investing mistake that I see all the time is people who don't have a clear reason for their money, right? They don't have a clear why, or they just set themselves on autopilot and just continue to invest over time without ever reviewing their investment portfolio or stopping to think, am I good? Do I have enough? Do I need to change this strategy? So it's taking yourself off autopilot and rethinking, why am I investing the money, right? What were my goals again? And have those goals changed? And then do I then need to change how I invest my money? You have to sit down and think about, what are your life goals? What are your career goals? At what age do you want to retire? What is your financial independence number? How much money are you trying to see that portfolio get to before you say you have enough? And making sure that that hasn't changed over time. And also making sure that you're reviewing it periodically. Yes, I think a set it and forget it portfolio is good for a day-to-day basis or a month-to-month basis, but I do think there is value in reviewing things at least once a year, because you never know what may have happened, right? Maybe your income has changed and now you make more now than you did in the past. And so now you have more money to invest and deploy. And do you want to invest it in a different way? Maybe you've gotten married. And so now you've gone from managing money by yourself to managing money with a partner. And so now you've got to make sure that your goals are aligned. Or maybe the reverse has happened and you've gotten divorced or you've been a widow or what happened. And so now you've got to rebalance. Okay, how do I navigate this thing as a single income earner instead of maybe a dual income household? Maybe you've had kids, right? And so now it's like, okay, well, I used to invest, I don't know, $40,000 a year into these investment portfolios, but now I've got kids and I've got bigger expenses and I got to think about their college education. And so now, how does the way that I spend my money, how does the way that I invest my money change? Maybe you've switched jobs and now you got some 1099 income, or your income has increased or decreased, or you're in a different role. And so one of the investing mistakes I see is people who don't have a clear reason for how they want to use the money and have not reviewed to make sure that they are investing in a way that still aligns with their life goals and their life changes.
All right. Well, Alicia, this is good. I think we've covered the majority of the mistakes here. And one of the last things that I would just say is taking advice from the wrong sources. And this is hard to gauge, honestly, when I say this, because I don't think people are intentionally giving us bad advice, right? I don't think people that are malevolent, they are using things that are working for them, but no one knows the intricacies of your own financial situation. And that is why it's really important that you understand, okay, what are key principles that apply to everyone at all levels versus what are these key principles that apply to me and my situation. And so you want to filter the information to really understand, what is your risk tolerance? Are you someone who can invest in crypto and Bitcoin because you like the wave? I don't know. That's not me. What is your tax situation? And would you actually benefit from investing this amount of money in lump sum into something that gives you a tax deduction? Or would you much rather just pay the taxes today so that you have the money in the bank? What is your time horizon? Because some people want to retire early, some people don't. And if you have a different time horizon, then that's going to impact the decisions that you make. And so it's really understanding and filtering the information that you get from other people. So it's okay to look at social media. Hell, we on social media and I think we have solid advice, but I would not recommend everything that we do with our money right now for someone who's a resident physician. You're not there yet. And so it's really important that you filter this through your own lens to say, okay, what in this applies to me and what of this information is a seed for me to explore and potentially plant later.
Yeah. And I think for those who have listened to this, whether it's this episode this week or the Common Investing Mistakes Part 1 from last week, one of the key takeaways is not just memorizing all the investing mistakes. It's saying, okay, what is a general framework that I can use to help myself going forward so that I can hopefully avoid some of this stuff? And I think the first one is, do I understand what I'm investing in? Generally speaking, how is my money being invested in? Do I understand it? And if you do not, you need to make sure that you ask or do some research to inquire about what you're investing in to make sure you understand it. And then you need to ask yourself, how does this fit into my long-term plan? Whether my long-term plan is to retire at age 50 like Brittany wants to do, whether my long-term plan is to make sure I have enough to pay for my kids' college education, whether my long-term plan is to make sure that I can hit my financial independence number by age 65, whatever it is, making sure that how you're investing fits into your long-term plan and you understand that so you can track how close or far away you are from reaching your goals. Then I think it's asking yourself, what are the risks involved in these investments? Yes, the potential for payoff might be very high, but is the risk that I could lose my entire investment? I see this all the time in folks who are investing in these real estate syndications. The minimum investment is like 50,000. It's projected to have an internal rate of return of 15%, but what happens if that doesn't happen? Part of the exit plan is to refinance. Part of the exit plan is to sell. Well, what happens if the economic climate does not allow for that? What happens then? And so just making sure that you fully understand not only the upside of an investment, but the risks of said investment. What are the fees and the taxes associated with this? Making sure that you're setting money aside for taxes, or that you're at least factoring in taxes and looking at expense ratios when you're making investment decisions, and asking yourself, are you okay if this investment experiences a little volatility? Are you okay if it goes up in value or down in value over time? And so one of the things that we want you to do is win in life and win in investing. And I think that that starts with making sure that you are investing and understanding what you're investing in and how it fits into your plan. And so if you've got a financial advisor, I would encourage you to schedule a meeting with him or her to kind of go over those things. If you've got a tax professional, meet with your tax professional to kind of see what your tax liability is and what are some different strategies that you could employ this year to maybe lower your tax bill and increase your net worth over time.
Well, this was fantastic. And I think it's time for us to transition, though, because I want to talk about fun money and I want to hear how you're spending your money. You always give me great ideas, Leisha. So, in one episode, you talked about simplifying your life and investing in some various AI tools that could help you maybe meal plan or could help you create your schedule and things of that nature. And so I was like, you know what? Let me do a little bit more research. Leisha out here listening to podcasts, watching videos, asking me questions, and I don't have good answers to these questions. So I have invested in an AI tool and I'm still discovering all of the possibilities here.
Which AI tool? Don't hold out on us. Are you using Claude or Copilot?
Claude. So I got
I have
Claude.
heard great things.
Yeah.
Do you like it better than ChatGPT?
So it's always challenging to do an apples to apples comparison of things because I did not pay for ChatGPT. I had a free version and, they're not going to make the free version as good as the paid version because otherwise, why would you pay? So I am still discovering all of the possibilities, but at least for right now, one of the things that I have appreciated is that I can give permission to do certain things in programs that I use. So for example, you can connect your email to the Claude and it can go through and kind of remove clutter and create things in folders and things of that nature. And so I'm doing that for the business accounts. I think for my personal life, I probably want to keep it separate because I'm always just thinking about what are you doing with my data? People send me very vulnerable things in my email. That's personal. And then it's also quite scary. The things that it can do, I'm like, oh my gosh, what does this mean for our workforce in the future? So anywho, all of that to say that I have purchased Claude and also there's an impetus to purchase that specific one given what's happening in the headlines here. So we're not going to make this podcast political, but yeah, I bought Claude and I'm still discovering its capacity, its capabilities. And I'll let you know.
Yes, please update us. One of the things that you can do in the paid version of Claude and I think ChatGPT is create these AI assistants, which I mentioned. So they can work while you're asleep. You can give them tasks. They can start to learn more about you and all of these things. And so I'm very excited about what AI could do. I haven't made the leap yet into the paid version. Girl, I'm getting so much value from the free. I'm like, wow, if this is that helpful, maybe I could branch into the paid version. And I hear what you're saying. Like, it does make me concerned about folks' jobs. I've listened to podcasts, as you mentioned, about some of the entry-level software engineers and computer engineers. There are fewer jobs available because oftentimes some of these AI tools can do that entry level work. And now they're just employing people to kind of supervise and code AI tools and prompt the AI tools. And so it'll be really interesting to see how things kind of progress over time, if you will. But okay, so some of the things that I'm doing for fun with my money is I haven't actually spent the money yet, but I am trying to think about what I want to do for my birthday. I know it's not until June. Your birthday is way before mine, but it's around this time of the year that I start planning. And I don't always go on a trip, but I was thinking my vacation days don't roll over at work, so I have to use them before I lose them. And everything ends June 30th. And so it just happens to be around the time of my birthday. So I was thinking maybe I'll go out of town. And so I'm strongly considering going out of town and I'm thinking about going going to Aruba. I know that's so random. And I'm like, do I want to make it a girls' trip? I'm just trying to plan and see where would I have the most fun. And I'll probably go the weekend after my birthday. So I'm like, let me see who has vacation days. Let me just scope out what would the prices be? What perks can I utilize? One of my credit cards has this Fine Hotels and Resorts credit that gives you like free breakfast and late checkout and access to upgrades. And so I was like, ooh, maybe this would be a good time for me to utilize that credit and like make a girls' weekend out of it. So anyway, I'm utilizing my fund money to sort of plan or at least put some feelers out for birthday plans.
I love that for you. Yeah, you'll have to let us know. I'm sure you will, where you go. At some point in time, we want to create a free resource guide of all of your trips and itineraries, which credit card you use, which credit you use, put it all together because I'm sure people really need that information as well. All right, people. Well, we hope that you learned a lot about this episode. And if you identified any mistakes that you are making, don't feel bad about it unless feeling bad is going to motivate you to do something different. We're not here to judge. We're here to just plant some seeds of ways to do things better, explore them, and see how you can improve your investing strategy. And we will see you on the next episode.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisa Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.